Buying and selling properties on wraparound mortgages can be an effective way for you to get your price and give people their terms. In this episode of the podcast, I'm going to walk you through all of the options that you could have with a wraparound mortgage as it pertains to an investment property that you're going to sell to a homestead buyer or another investor. So without further ado, let's jump in. All right, episode 6 of the Creative Acquisition Podcast. In today's episode, we're going to talk about wraparound mortgages, buying wraparounds or buying on wraparound terms, and then selling on wraparound terms. And in this particular episode, I'm going to walk you through how to acquire a short-term rental using a wrap or seller financing at the beginning, and then also exiting that property on the same kind of terms. So I'm going to look at some of my notes here so that we can hit some of the high points for you, because this is going to be incredibly important, okay? So first thing, what is a wrap, right? A wrap is when you basically have a mortgage. There's a mortgage on the property, and then there's some seller financing that exists on top of that. So let's say there's $1 million price with an $800,000 mortgage, but you put $100,000 down. So $1 million minus 100 is 900, but the mortgage is 800. So you've wrapped around that $800,000 mortgage with an additional $100,000. So here's what's incredibly important about that. That's how you bought the deal. You can also exit the deal on wraparound terms. So let's say you've had this property, you've cash flow $1,000 a month for 4 or 5 years. Now the property is worth $1.2 million and you want to wrap it, but you're only taking a $100,000 down payment. So $1.2 million minus $100,000 down payment gets you a $1.1 million mortgage that you're issuing to the person who's buying your deal. At the same time, you bought the property with a wrap at $900,000, which has now been paid down probably to $850,000 over the 5-year period. So you have a $1.1 million note and a $950 note. So you have this gap in between, okay? So that is wrapping a wrap. Now, the interesting thing is each of those mortgages are going to be on 30-year terms, but the thing that's really, really interesting about this whole concept is when you go to sell a property, you're always trying to get your highest price with the lowest cost to exit that property. Because remember, you pay about 10% to sell a property, 5 or 6% to agents, 1 or 2% to closing costs, transfer fees, maybe dropping or price reductions. You get to about 10%. And so you just blow out a bunch of your gain that you had within a property. So if you want to retain equity, if you want to retain your property, what you're going to do is you're going to sell on wraparound terms. Now, you're not going to get all your equity out, because remember in our example, you're selling at $1.2 million and you bought at $1 million, plus you put $100K down there. So in theory, you have about $300 and something thousand in equity plus the mortgage pay down, call it $350,000 in equity. If you sell it cash on market, you'd get $350,000 immediately and you can do whatever you want with it. The problem with that, the big problem with that is 3 things. Number 1, you're going to create a big tax problem. So you're going to have to work on a 1031, a reverse 1031, deferred sales trust, a bunch of different crazy strategies to be able to try to defer that income. Second thing is you got to have something to do with the $350,000. Lots of people have no idea how to do anything with that money. You're not just going to take it, put it in the market and call it a day. That's probably not going to happen. So really, the other thing is earning interest, right? That's the third thing. You want to earn interest on your money, because if you're going to place your money somewhere, you might as well earn interest on it. So the most important thing is to ask yourself, what is your goal and what is your investment horizon? We've talked many times about if you buy a property a year from 30 to 60 and then start dispositioning a property every year from 60 to 90, you're in a great position. Well, let's say you find a property that has great value now and you want to exit this property sooner than later. Here's how you can do it. You take the property, you find a buyer, and you get a down payment that is less than basically the combination of all the debt that you owe. So you bought it at $1 million, you put down $100K, there's a maybe $800,000, $900,000 mortgage in there. You got to make sure that your mortgage you issue to somebody else is larger on the same terms. So if I have a $900,000 mortgage and I issue somebody a $1.1 million mortgage, think about what happens there. There's a $200,000 spread between my mortgage to the original seller and my mortgage to the new buyer. If I have a $200,000 mortgage that then has, let's say, 5% interest on it, right? I'm going to earn $10,000 a year in interest by holding the paper between the buyer and the seller. $10,000, it's almost $1,000 a month. Yes, you don't own the house at that point. Yes, you have depreciation recapture. Yes, you don't own the asset. Yes, you don't get cash flow, but you're building a cash flow asset with a big balloon payment in the future. So you're getting consistent payments secured by real estate which is one of the best things you could possibly do. And more people don't do wraps because they don't understand them. They're risky, they're difficult. You got to know how to get an end buyer. There's a million reasons why wraps aren't a good fit. But if you're somebody who wants to get into the real estate space and you want to buy a short-term rental today because you like the benefits of a short-term rental today from a cash flow, appreciation, equity standpoint, and you want to sell later, instead of just going on market, dropping 6% on agents plus another 3 or 4% in fees, consider a wrap. There's lots of groups out there. There's creative finance groups like Pace Morby's group. There's a bunch of on and off market real estate groups. There's FSBOs, right? For sale by owner. There's a gazillion ways for you to sell, and selling on a wrap allows you to make the spread between your underlying mortgage that you have and the mortgage that you reissue to the next person. That also comes with very large balloon payments. So imagine you had a $200,000 spread. So there's a mortgage at $900,000 and one at $1.2 million. Well, remember, at some point, interest is being paid on most of that loan, but then there's a lump sum payment that's going to be due to you. And that lump sum payment you can control in the future when that's due to you by setting parameters. You can set prepayment penalties. You can set renewal schedules. You can set all kinds of different terms that allow you to exit the property. So not everything has to be a sale, a 1031, a reverse 1031, some kind of trust strategy, some kind of deferral strategy that you need to worry about trying to make sure your money is still tax advantaged. What happens is you can sell a property on creative finance terms so that you can get the highest price possible. Remember in some of our drawings and other videos, we talked about price and terms, right? You want your price. Okay, we do my terms. Okay, if we want to flip that, you're willing to lower your price. Okay, well then it kind of goes to a cash offer because the terms, you can't have price and terms. Very, very challenging. So the next time you get into this space, okay, the next time you get into buying a deal, don't be stressed out about the way that you can exit. Buying on wraps and selling on wraps are more than fine. Couple things to keep in mind: the interest rate that you have on your subordinate wrap, right? So the mortgage that you have, if it's 5%, you really should offer 5% or higher on your mortgage, even if you have a bigger number. That way the amortization schedules are lined up over and over again. If you have a 5% mortgage and you offer someone a 4% mortgage, you kind of get negatively casted. And there's nothing wrong with that as long as the amount of dollars that you are charging them, like the principal balance is really high, you're okay. But exiting short-term rentals on wraps can be a phenomenal strategy. I'm in the process right now of doing that. And the reason we're doing that is because we're trying to get outside of a prepayment penalty. So here's a really good use case for wraparound mortgages. Let's say you buy a house conventionally, 20% down, 80% from a bank, and they have a 5-year prepayment. 80 Mortgage is a perfect example. 80 Mortgage has a lot of 5-year prepays, and the way that their prepayment rule works is that they have 6 months of interest only on the principal loan balance due as a penalty. So let's say you bought $1 million house, then you had an $800,000 mortgage, and let's say the mortgage was 10%, just to make it really crazy for a second. 10% of 800,000 is 80,000. They take half that, which is 40,000. So 6 months of it, 40,000, and that's your penalty to get out of that loan. Now, that would be applied to the outstanding principal amount. So if the mortgage was 800, but it's 5 years later, so now it's 730,000 or whatever the math is, you would pay 6 months of interest at 10%, so really 5% on whatever is left. So instead of 40, it'd be like $35,000 or $36,000. That's how prepayment penalties work, okay? And a lot of them are not step downs. A lot of them are just for 5 years, it's 6 months of interest based on the principal at that time. So how does a wrap play into that? Well, a wrap plays in because if you have a loan like that and you want to sell a property, but you do not want to get smoked with those penalties, and you know those penalties happen at that time, you can sell the house in a wrap, keep that mortgage in place, get outside the prepayment window. And once you're outside the prepayment window, you won't have that issue anymore because you can basically just have them refinance the property or take an assumption on that loan. Probably if the interest rate's high, they're not going to do an assumption. They're going to refinance it. If the interest rate's low, somebody might say, hey, listen, I'd like to assume a 3 or 4 or 5% interest rate. So a wrap for an exit is a good way to get outside of a prepayment penalty. Other reasons a wrap might be important is maybe you had a really good year in your business or other businesses, wholesaling, fix and flipping, wherever you earn your income. And so if you sell a property, you're just going to add a ton more gain to your plate, right? You bought it at $1 million, sold it at 1.2, you got $200,000 in gain, let's say, right? Well, maybe you don't want that on your income right now, right? Maybe you want that next year. So if you do an installment sale, deferred sale, You can go check this out online. There's lots of documents about it. But doing a wrap allows you to say, okay, I'm going to take payments over time and I'm going to take a smaller down payment. That way I can push some of that into the future. You're still going to owe all the same amounts. You're still going to earn the same amount, but your payments in the future are going to be broken down into depreciation recapture, interest income, return of capital, and capital gain, right? So every payment, you get $5,000 a month, that payment's broken into one of those 4 categories. And by doing a wraparound mortgage, you can push some of that into the future. Now, keep in mind that interest income, this is really important, interest income is taxed as ordinary income. So anytime you sell a property, you need to realize that return of capital is not taxed. It's money you put in, you get back. Depreciation recapture has some different calculations, anywhere from 25 to your ordinary tax rate is recapture. And cap gains is 0, 15, and 20%. So depending on your strategy, you might be able to do an installment sale to defer into the future. Another alternative people think at is 1031s and reverse 1031s exchange. But the problem with those is they got to be timed very carefully, right? You got 45 days to identify up to 3 properties for the trade, and an additional 135 days to complete the sale. So a 180-day window. If properties fall out, it's a problem, and you got to have at least 3 properties. There's a million reasons why those are really challenging. And so the wrap can solve some of that for you by allowing you to have some cash now that you can go invest wherever you'd like. And you also get to have a deferred payment schedule into the future. So just the next time you think about getting into a deal and then you want to exit it because you've locked in a gain, your property's gone up in value, think about selling on wraparound terms, okay? This is something that can be incredibly useful. Remember, please remember that anytime you do a wraparound, if you are guaranteeing the mortgage, the first mortgage that was in there, and somebody misses that payment, whether it's loan serviced or not, you still have to make that payment. So there's some inherent risk there. You got to be very, very careful if your credit's tied to it or you're looking at bankability in the future, because mortgage rates can be challenging to remove. When you have capital calls within a business where you have to put money in for like an improvement, you got to make sure you get the money in, you get things paid on time, because otherwise your credit will continue to get smashed, boom, 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 time and time again. So hopefully that makes sense. On your next transaction, when you buy a property, remember there's really 4 creative ways to buy. Seller finance, where they own it in cash. Subject to, where you're taking over their exact mortgage. A hybrid, which is when you have seller financing and sub to. And then any other types of carrybacks or combination carrybacks, where you have seller financing and bank financing together, okay? Those are the 4 main strategies for seller financing. The way you exit on the wrap can be very, very beneficial to you if you can think about this. So if you're just watching this and just getting into real estate and you're like, wow, this is a really complicated video, I don't understand wraps, don't worry. You need to buy a property, build the property, cash flow the property, get the benefits of the property, get going with that property, and you can think about this in the future. All I'm saying is when you think, hey, I want to exit a property, and you're worried about, am I getting the best price? Do I have to pay an agent? Do I have to consume all these closing costs? There's probably an off-market way for you to sell your property, and the most enticing thing to a new investor or somebody who would buy your property is a low down payment. If you're willing to do a wrap, you can take a lower down payment and wrap whatever debt you currently have or equity into a payment and push that to the next buyer. That is a great way to build wealth, as long as you can track it, as long as you can keep it organized from an accounting standpoint. If you want to learn more about wraps, you can drop the word wrap in the comments, and I'm more than happy to make additional videos. I'm not trying to go super deep here on the podcast on this because it's something that has a very limited use case, but I wanted to put it early on so anybody who feels stuck in a deal, because there are people who are stuck in short-term rentals that they don't love, you can exit this to a homestead buyer, another real estate investor, someone doing pad split or a midterm rental or a long-term rental, and you can sell it on a wraparound term. The last piece I will leave you with, negatively casted mortgages. If you have a payment that's $5,000 a month and you aren't cash flowing and you want to sell it on a $4,000 a month payment, you can do that, but you create a negatively casted mortgage, which means you're paying $5,000 as the seller, the buyer's paying $4,000, so you're losing $1,000 a month. However, let's suppose that you're losing more than that within your deal. You might be able to pull out cash $100,000, $200,000 up front to be able to take that loss over time, which spreads that into the future, which might be beneficial to you. So you can do positively casted wraps where you have a $5,000 payment and the buyer has a $6,000 payment, or you can do negatively casted wraps where you have a $5,000 that turns into a $4,000. There's a million ways to be successful with real estate. Please, please, please read up on wraps, read some of the blogs, read some of the content, and try this for yourself. You always need an attorney. You always need somebody who knows how to put these pieces of paperwork together. You probably don't necessarily need an agent to do this kind of work, but it's very, very, very important that you understand all of these strategies so you have all the tools in the toolbox when you go to make a move in the future. As always, I appreciate you guys watching another episode of the podcast, and we'll see you on the next one.